Did you know the rules for your silver ETF just changed in a big way, and almost nobody noticed? A major silver ETF, SLV, quietly updated its prospectus late on Friday, December 26th, right before a holiday weekend. This is a classic move to bury important news during a low-visibility period. So, what was in this update? It's a game-changer. The new language allows the ETF to settle redemptions in cash instead of physical silver during what they call extraordinary market conditions. Now you might think, okay, cash settlement, what's the big deal? Here's the catch. The price for that cash settlement isn't determined by the market or the spot price you see on your screen. It's determined by the trustee. This gives them the legal power to cash you out at a lower price, even if the price of silver is skyrocketing. Imagine silver spikes to $100 an ounce, but they can legally force you to sell your shares at Friday's closing price of, say, $30. You lose all that upside, and they get to keep the physical silver. This isn't just an isolated incident with one ETF. Within a 72-hour window, similar language has appeared across multiple major silver vehicles. We're talking about SLV, PSLV, Aberdeen, and even major players like JP Morgan, HSBC, and the COMEX Futures Exchange. They've all aligned their settlement rules. This coordinated move is critical because it creates what's known as a force majeure window, which officially went into effect when the markets opened on Monday. What is a force majeure clause? In simple terms, it's a contract provision that allows a party to suspend their obligations, in this case, delivering physical silver, due to events deemed beyond their control. They're framing the very real physical silver shortage as one of these uncontrollable events. But let's be clear, this shortage wasn't an act of God. It's the predictable result of decades of creating more paper silver claims than there is physical metal to back them up, a practice known as fractional reserve banking applied to precious metals. Let's walk through a potential scenario. The market opens, and there's a huge surge in demand for physical silver. The price starts to climb rapidly. Instead of delivering the metal, these institutions declare a force majeure event. They could then force investors in their paper products, like ETFs, to cash out at a predetermined price, perhaps the price from the previous day's close. Meanwhile, the real-time price of physical silver continues to soar. Who wins in this scenario? The institutions. They get to keep the physical silver, which they can later sell at a much higher market price. Who loses? The investors holding the paper claims. You thought you owned silver, but you just owned a contract that they can now legally break. This isn't just a market fluctuation. It's a mechanism for a massive legal wealth transfer from individual investors to large financial institutions. The coordination is key here. If only one ETF did this, they'd face immense legal challenges and reputational damage. But when multiple major entities do it at the same time, it's no longer an individual action. It becomes a systemic crisis. They can all point fingers at each other in the market, claiming it was an unavoidable situation that required a system-wide response. This drastically reduces their legal risk. This risk isn't limited to just ETFs. The COMEX futures market has similar clauses. If you're holding a silver futures contract expecting delivery, they can also opt to settle you in cash at a price they determine. What about silver mining stocks? While they're not paper silver in the same way, they are indirectly exposed. Trading algorithms that drive stock prices react to the paper price of silver, not the physical market conditions. So if the paper price is artificially suppressed or frozen, mining stocks could get hammered, even if the underlying metal is in high demand. The same goes for pool accounts and any form of unallocated silver holdings. If you don't have specific serial numbers attached to your bars in a fully allocated storage account, you are facing the same risk. Does this sound familiar? It should. We have historical precedent for this kind of action. Back in 1933, the U.S. government executed Executive Order 6102, which forced citizens to sell their gold to the government at a fixed price of $20.67 per ounce. Shortly after confiscating it, the government revalued gold to $35 an ounce, pocketing a massive profit. What we are seeing now is like a modern private sector version of that playbook. Instead of a government decree, it's being done through contract law, the fine print you agreed to when you bought shares in that ETF. Because you technically agreed to these terms, any legal challenges are extremely unlikely to succeed. The timing of this update is no accident. Filing it just before a holiday weekend was a deliberate strategy to minimize public attention. and give all the major players time to coordinate their actions without spooking the market. Monday's market open was positioned as the trigger point. From that moment on, these institutions have the legal framework in place to declare force majeure whenever they choose. So, what does this mean for you as an investor in silver? Your choices are limited, and you need to act thoughtfully. You could try to sell your paper silver holdings immediately before any such event is triggered. Another option is to move your capital from ETFs and unallocated accounts into fully allocated, segregated physical bullion, where you have title to specific bars. Or you might decide to exit the paper silver market entirely and only hold physical metal that you personally possess. The central warning here is that instruments you thought were a safe way to invest in silver might actually be a trap. In a real crisis, these paper claims may not be honored. The only asset that appears to be free from this risk of cash settlement is physical silver that you hold directly, or that is held for you in a fully allocated and segregated account. This isn't just a market downturn we're talking about. It's a fundamental change in the rules of the game. We could be on the verge of one of the most significant wealth transfers in the history of the silver market, moving wealth from the hands of paper holders to the institutions that control the physical supply. Stay informed, review your holdings, and understand the fine print. Thank you for watching, and be sure to subscribe for more updates on this developing story.